Imagine waking up one morning to hear that a major bank has failed. People are panicking. Stocks are plummeting. ATMs are running dry. And yet, by the end of the week, the headlines are reassuring. Markets stabilize. How did that happen? How can an entire economy wobble on the edge of collapse, and yet seemingly recover almost overnight? The answer lies in the hidden toolkit governments use to smooth crises. Actions so subtle and complex that most people never notice them, but so powerful they shape the lives of millions. It matters right now because crises aren't rare. They are predictable. Banking crashes, inflation spikes, sudden unemployment surges. They happen with alarming frequency. And every time governments step in, sometimes the results are miraculous. Other times, messy. Understanding how this works isn't just academic. It affects your savings, your job, and the value of your money. At the heart of the process is timing. Governments act in stages, not all at once. Central banks, the institutions in charge of money, have tools that sound abstract but are shockingly effective. Interest rates can be nudged up or down to encourage borrowing or saving. Quantitative easing, a term that sounds like a magic spell, is really just the central bank buying assets to pump liquidity into the system. On the surface, it looks like a trick, but underneath, it's carefully calculated. Every action sends signals to investors, businesses, and consumers. Then there's fiscal policy. Governments spend or cut taxes to stabilize demand. During recessions, they might increase infrastructure spending to create jobs, or offer temporary tax relief to keep people spending. It's a delicate balancing act. Too much stimulus and inflation surges. Too little and the economy slides further into recession. The math behind these decisions is uncomfortable. Economists work with models that assume human behavior can be predicted, something that, in reality, is far from true. One of the most fascinating tools is guarantees. Governments promise to back banks, loans, or even entire industries. During the 2008 financial crisis, this guarantee wasn't just a safety net. It was a message to the market. The system won't collapse. That simple signal calmed panic faster than any headline could. And yet, there's irony here. These guarantees create moral hazard. Banks know they are protected, and sometimes take bigger risks, sowing the seeds of the next crisis. The speed of modern communication amplifies both risk and response. Data flows instantly, and markets react faster than ever. Governments have to act preemptively, sometimes before the problem fully exists. They rely on simulations, historical patterns, and instincts honed over decades. The absurdity is striking. The economy is a complex web of human behavior, yet it's influenced by decisions made in conference rooms with spreadsheets and predictive models. There's also the hidden coordination across borders. Crises are rarely contained within one country. Financial markets are global. A collapse in one economy can ripple worldwide. Governments share information, coordinate policies, and sometimes act in unison. The stakes are enormous. A misstep in timing or magnitude can transform a contained problem into a global meltdown. But smoothing crises isn't just about large-scale interventions. It's psychological. Confidence is currency. When consumers believe the government has a plan, they spend. When businesses trust the system will endure, they invest. Conversely, fear can create self-fulfilling collapses. This is why governments spend so much energy on messaging, speeches, and assurances. The invisible hand they stabilize is not just the economy, it's human perception. Yet there's a tension between hype and reality. Headlines celebrate the rescue of markets, but the math often tells a grimmer story. Stimulus packages create debt, interest cuts reduce future returns, and guarantees shift risk elsewhere. Crises may appear smooth in retrospect, but behind the curtain, trillions of dollars move, people lose jobs, and assets are redistributed. The process is messy, high stakes, and rarely entirely fair. Zooming out, we see the bigger implications. These tools, while stabilizing, can encourage risky behavior over time. Economies become dependent on interventions. Markets expect bailouts. Debt grows. Policymakers must constantly weigh the immediate need for stability against long-term vulnerabilities. It's a silent tension that plays out in the background of every economic headline, often unnoticed by the public. And here's the uncomfortable truth. Smoothing a crisis doesn't erase it. It delays, redistributes, and sometimes magnifies underlying problems. Every intervention carries trade-offs. Every decision is a gamble with billions of dollars and millions of lives at stake. The system is neither flawless nor fair. It's human, reactive, and adaptive. So what should we take away? Crises will continue. Governments will continue to intervene. And while the tools they use are sophisticated, the outcomes are never guaranteed. The question that remains, and perhaps the one that matters most, is this: how much are we willing to rely on unseen hands to stabilize a world that is, by nature, unpredictable? Because in the end, the economy moves not just on money, but on trust, perception, and timing, and those are variables even governments cannot fully control.